What is coming out of Iran is bigger than most people understand, bigger than the headlines explain, and much bigger than the average investor is prepared for. When a shock like this starts moving through oil, inflation, rates, and fear all at once, it does not simply create noise. It creates forced selling. It creates confusion. It creates the exact kind of environment that wipes out weak hands and rewards prepared ones. Most people hear a story like this and think danger. I hear it and think opportunity. Not because I enjoy chaos. I do not. I have simply lived long enough to know that chaos always arrives wearing a different costume while the market keeps repeating the same behavior. The names change. The headlines change. The emotion never changes. Fear expands. Prices break. Good assets get thrown away with bad ones. Then, years later, people call the survivors obvious. That is the entire game. If oil keeps climbing, production costs climb with it, transportation costs rise, inflation gets another wave of pressure. Consumers get squeezed. Small companies with no durability start cracking, and the Federal Reserve, which many people assume can rescue everything, suddenly loses room to act because inflation does not give them permission to cut aggressively when the economy is already wobbling. That is how you get the setup. Everybody claims to fear slower growth, sticky inflation, a market that stops acting like a vending machine. Good. I do not say that carelessly. I say it because a real investor does not build wealth in the part of the cycle where everybody feels clever. He builds it in the part of the cycle where fear makes quality temporarily cheap. I have watched this pattern repeat for more than a century of market history. The trigger is never the same. Sometimes it is a war. Sometimes it is a mortgage collapse. Sometimes it is a technology bubble. Sometimes it is a pandemic. Now it may be Iran, oil inflation, and another round of macro stress. The reason changes, the structure does not. Panic arrives. Prices fall. People forget the difference between a business that is wounded and a business that is dead. That difference is where fortunes are made. When everybody feels brave, discipline matters. When everybody feels terrified, judgment matters even more. I have always believed that you want to be greedy when others are fearful. But that does not mean buying blindly. It means knowing exactly what you want before the discount appears. So let me be plain. I am not interested in chasing oil because oil is not a long-term compounding machine. Oil is cyclical. It spikes, it collapses, it gives traders a story and then takes it away. I am not interested in hiding in cash as if cash were safety. Cash is often a slow leak. Sit in it long enough, and inflation silently removes purchasing power, while you congratulate yourself for feeling calm. I am not interested in building a decade-long plan around short bursts in defense stocks or temporary runs in classic defensives either. Those trades can work for a season. I am thinking in decades. What I want in a shock is not what rises for 6 months. I want what survives, strengthens, and compounds for 10 or 15 years after the panic is gone. That is the lens. Crashes do not usually destroy the patient owner of strong businesses. Inflation does, bad behavior does, panic does, selling the future because the present feels loud does. The investor who makes it through periods like this is the one who can separate temporary pain from permanent impairment. So when I build a shopping list for a moment like this, I start with the things the world will need more of after the smoke clears, not less of. The first group is reliable power. Artificial intelligence is not just a software story. It is an electricity story. It is a cooling story. It is an infrastructure story. If the world is going to keep pushing deeper into AI while energy systems remain strained and geopolitical risk keeps threatening supply, then the businesses that provide dependable power cooling and on-site generation become more valuable, not less. That is why I pay attention to companies like GE, Vernova, Vertiv, and Bloom Energy. They are not the fashionable part of the story. They are the practical part of the story. Vernova gives you exposure to the power build-out. Vertiv sits right where AI meets the physical world of cooling and power management. Bloom Energy offers on-site generation that does not depend on a fragile grid behaving perfectly. In a world where oil stress and AI demand can exist at the same time, that matters. The second group is memory. Every technology cycle has a bottleneck. People usually see it late. Right now, one of the most important bottlenecks is memory. The more ambitious AI becomes, the more context it needs, the more bandwidth it needs, and the more memory it consumes. If the world suddenly demands far more advanced memory than current supply chains can comfortably produce, then the businesses already positioned there gain pricing power, relevance, and time. The source material names three dominant players in that lane: Micron, SK Hynix, and Samsung. I understand the logic. If you own the scarce layer in demand surge, you can print extraordinary results for years. My own bias has always been toward simplicity and toward businesses. I can understand and follow with confidence in that framework. Micron is the name that fits most naturally. It gives you a direct line into the memory squeeze that AI is creating without pretending that the shortage will solve itself overnight. The third group is production. You cannot have an AI supercycle without the physical production stack that makes it possible. The market loves to obsess over the obvious names, but the deeper truth is that this ecosystem runs through several indispensable layers: the GPUs, the chip designers, the fabrication, the lithography, the connectivity. Miss those layers, and you miss the architecture that actually carries the boom. That is why NVIDIA and AMD matter. That is why ASML matters, because it sits in a near monopoly position in the machinery that makes advanced semiconductor manufacturing possible. That is why TSMC matters, because somebody still has to build the chips at scale. That is why ARM, Cadence, and Amphenol matter, because design tools and connectivity are not optional details. They are part of the backbone when the world is unstable. Investors tend to shorten their thinking. I try to lengthen mine. The question is not whether volatility will hit those names. Of course it will. The question is whether the world will need more of what they do 5 years from now than it needs today. I believe the answer is yes. The fourth group is what I would call decision infrastructure for chaos. Periods of disorder do not reduce the need for intelligence. They increase it. Companies, governments, and institutions need to know more, not less. They need better visibility, faster judgment, stronger security, and systems that help them operate while everything around them becomes harder to predict. That is why Palantir stands out. It is why CrowdStrike matters in cybersecurity. It is why Datadog, MongoDB, Oracle, Microsoft, Google, and Amazon deserve a place in serious thinking in a calm world. Those businesses are useful. In a disorderly world, they become more deeply embedded. When the environment gets harder, mission-critical software becomes stickier. I have always cared about staying power. I want businesses that move from nice to must have when the real world becomes stressful. That is one reason Palantir keeps showing up in conversations like this. It helps institutions make decisions in moments where bad decisions are expensive. Those moments do not disappear in crisis. They multiply. The fifth group is automation and real-world productivity. When inflation stays high and uncertainty keeps pressure on margins, businesses start searching for leverage. They do not want more friction. They want more output from the same labor, more intelligence from the same data, more efficiency from the same infrastructure. That is exactly where automation, robotics, software, financial platforms, and scalable productivity tools start earning their keep. Tesla belongs in that conversation not only because of vehicles, but because of robotics and autonomy. Meta belongs there because advertising that gets cheaper and smarter is still a productivity engine. Amazon belongs there because it touches both cloud and real-world commerce at a scale that is hard to replicate. SoFi belongs there as a financial platform with real operating leverage. The source also includes Robinhood as an honorable mention, and I understand why. When capital markets participation expands, platforms that simplify access can become far more important than they first appear. What ties all of these together is not hype, it is function. These are businesses trying to help the world do more in a harsher environment. Now let me tell you what I do with all of this, because a shopping list without a system is just noise. I do not build a portfolio by lunging, I build it by pacing. I want an SP 500 core because broad ownership of American business still matters. I want position sizing that lets me sleep. I do not want margin. I do not want leverage. I do not want a forced seller anywhere near my process. If a shock unfolds over months instead of days, I want buying power left. If prices fall further, I want to be grateful, not trapped. That means I buy slowly. I do not assume I know the bottom because I do not. I assume fear can overshoot because it always can. So I use a disciplined averaging framework I add to quality while weakness is giving me terms I could not get in easy times. That is how a serious investor behaves when the market offers him temporary stupidity. The people who get destroyed in periods like this usually share one trait. They do not have a system. They have emotions. They either freeze in cash, chase whatever is moving, or throw capital around in a panic because they want to feel decisive. That is not investing. That is self-medication. The truth is simpler than most people want it to be. You do not need to predict every geopolitical headline. You do not need to trade every oil spike. You do not need to become a macroeconomist overnight. You need to know which businesses can emerge stronger after stress, and then you need the temperament to buy them when fear temporarily puts them on sale. If you look across nearly a century of market history, the bull markets have lasted longer, carried further, and created more wealth than the bear markets ever destroyed. The market keeps advancing because revenue advances, margins advance, productivity advances, and strong businesses keep taking share. The red periods feel louder, the blue periods make more money. That has been true again and again. This is why I am not stressed by the possibility of another shock. I respect it, I prepare for it, I do not worship it in the long run. The stocks that matter are the ones whose revenues keep climbing, whose margins keep improving, and whose products become more necessary with time. Noise can throw those stocks around for a quarter or a year. It cannot override business reality forever. If a company keeps widening operating margins, keeps improving profitability, keeps becoming more essential, the stock price eventually follows that truth. That is why I care less about the current panic than about the future earnings power on the other side of it. So here is the practical conclusion. If the Iran shock deepens, if oil keeps feeding inflation, if the market gives you a real washout, do not waste that pain by buying whatever happens to be on television. Use it to acquire businesses tied to durable power, essential memory, AI production, decision infrastructure, cybersecurity, automation, and real-world productivity. Use it to buy companies that can still be much larger. When this whole scare is 10 years behind us, history is not about to end. It is about to repeat. And when history repeats, the prepared investor does not ask how to feel better. He asks what he can own today that will look painfully obvious in hindsight. That is the last big wealth opportunity most people miss, not because it was hidden, because they were too frightened to act when it finally arrived.